Let's bring in Ron Insana, CNBC senior analyst and commentator and co-CEO of Contrast Capital. Michael Clarfeld is portfolio manager with Clearbridge Investments. Ron, one of the things that interests me, and I was very persuaded by it in your op-ed, is that you point out that residential real estate is collapsing, auto sales are down, manufacturing activity is contracting. How do we avoid recession, or do we?
I don't know, and I refer to it as a trifurcated economy. We've got three different groupings, really, of activity in the economy. We've got, as you said, those things that are in recession. We've got some businesses that are booming, like travel, tourism, hotels,
yep.
Restaurants are doing very, very well. You've got inflation in some sectors of the economy, disinflation in others. Then you've got strong jobs overall, but certain sectors that are laying off people by the tens of thousands. So I think the current environment defies an Econ 101 moniker, whether it's, recovery, recession, stagflation, you name it. None of those words and phrases really apply to the current situation.
Michael, how about you? I mean, we point out those sectors that are either in or seem to be softening, heading towards recession. We know that the yield curve is inverted. We suspect that the Federal Reserve is going to raise interest rates once, maybe two, maybe three more times. Do we avoid recession? And what are the safe havens for investors if perhaps we don't?
Yeah, I think this economic cycle and this market cycle has really defied most forecasters. It's very challenging. It's so unlike anything we've seen before. And I think rather than sometimes try to fully predict what's going to happen, try to figure out an investment strategy where you'll be relatively successful under a range of scenarios, because obviously, a lot of different things could happen. And that's really where we think the attractiveness of high-quality dividend growers comes in. If inflation's persistent and interest rates are higher for longer, high-quality dividend payers will be a pretty good place to be, because it's likely to be a choppy market environment, and dividends usually provide some downside protection. And from an inflationary perspective, dividend growth could help to offset the ravages of inflation and protect your purchasing power. On the flip side, if somehow we're lucky enough that actually inflation is near peaking and the Fed's in a position to cut interest rates, in 9 to 12 months, which isn't really our base case, but is certainly a possibility, then we'd expect a pretty strong strong market recovery, and we'd expect dividend growers to participate nicely.
So that's kind of the argument for not just owning, for instance, Ron, 6-month Treasury bills, that maybe you have more market upside. If you'd like that upside along with the yield, I don't know, a lot of people go, I'll take 5.1% in a T-bill right now. Yeah.
But even then, in a 1 year.
Well, and that's the thing. So they go, okay, well, you get that for now, but then in 6 months, I guess the implication is yields are lower, and this is a sweet deal while it lasts.
I mean, listen, I'm throwing most of my theses out the window, because we thought the Fed would over-tighten. We thought there'd be a broad-based recession, and then you'd see the Fed pivot or pause or pivot. None of that's happening right now. And again, you break down today's inflation numbers, 9.6% of the increase in the PCE was energy, which has already come back down. You were talking about natural gas, but crude oil prices have fallen, gasoline prices have fallen, commodity prices broadly are falling, and it's not yet translating. Housing is coming down in price, not showing up in some of these indicators. So
I'm going to say something real crazy.
Okay.
But it's not that crazy to argue. Well, or maybe it's a little crazy.
Sounds like conversations I have at home.
That maybe
I'm going to say something real crazy.
just maybe they don't need to tighten in response to these lagging inflation reports. I mean, the business cycle may still be intact, and if so, the playbook clearly points towards a big slowdown coming. And I don't know if we really need to freak out over the January data when we kind of know where we're going.
Well, not only that, I think, one policy tool does not fit every problem that we have right now. I mean, the labor market is tight irrespective of interest rates. It has everything to do with demographics. We're not overheating with a 2% economy. Capacity utilization's at 78%. You don't overheat in the manufacturing sector, so you cross 85. So again,
and
typical business cycles
in recession for a year.
So I wish someone would have some enlightened commentary about other policy tools we might be able to use to address some of the issues in the economy that don't just fall in the Fed's lap.